Okay, restarted the recording. I'm going to take a new one for this one. Okay, so we've covered all of our stock tickers, and we have a pretty good bearing on what we think the market is going to do next week. Now it's time to move on to monetary policy and what the hell the Fed is doing, as well as what's been going on in England. So there's a few pieces of news that I've been keeping a close eye on. So this was just shared by Scrap Queen. Thank you, by the way, for bringing this up. So Bank of England says that pension funds were hours from disaster before it intervened. The central bank's financial policy committee stepped in after a massive sell-off of UK government bonds known as gilts, following the new government's fiscal policy announcements on September the 23rd. The plunge in bond values caused panic, in particular for Britain's $1.5 trillion, or 1.5 trillion pound, equivalent to 1.69 trillion US dollars, in so-called liability-driven investment funds, or LDIs. Bank of England staff worked through the night to design a package that would prevent the collapse of a slew of LDIs widely held by pension plans the following morning. The Bank of England told lawmakers that a number of pension funds were hours from collapse when it decided to intervene in the UK long-dated bond market last week. The emergency measures included a 2-week purchase program for long-dated bonds and the delay of the bank's planned gilt sales, part of its unwinding of COVID pandemic-era stimulus. The plunge in bond values caused panic, in particular for Britain's £1.5 trillion liability investment funds. Many LDIs were owned by final salary pension plans, workplace pensions popular in the UK that provide a guaranteed annual income for life upon retirement, based on the worker's final or average salary. The LDIs needed to liquidate substantial portions of their long-term gilt positions as the value of the bonds fell early last week, and could have done so in an orderly fashion providing gilt prices did not deteriorate too rapidly. In a letter Wednesday to Conservative Party lawmaker Mel Stride, chairman of the Treasury Select Committee, Bank of England Deputy Governor John Colossal revealed that LDIs issued dire warnings on the evening of September 27th as 30-year gilt yields rose by 67 basis points from their position that morning. Yields move inversely to prices, something that we're all well aware of. Quote, the bank was informed by a number of LDI fund managers that at the prevailing yields, multiple LDIs were likely to fall into negative net asset value. As a result, it was likely that these funds would have to begin the process of winding up the following morning. Quote, in that eventuality, a large quantity of gilts held as collateral by banks that had lent to these LDI funds was likely to be sold on the market, driving a potentially self-reinforcing spiral and threatening to sever disruption of core funding markets and consequent widespread financial instability, unquote. Bank of England staff worked through the night on Tuesday, September 27th, to come up with an intervention that would avert this potential crisis in close communication with the UK Treasury, which agreed the next morning to indemnify the bank's rescue operation. The 30-year gilt yield fell more than 100 basis points after the bank announced its emergency package on Wednesday, September 28th, offering markets a much-needed reprieve. Cunliffe noted that the scale of the moves in gilt yields during this period was, quote, unprecedented, with 2 daily increases of more than 35 basis points in 30-year yields. This is actually a rather extreme move. We should probably take a look at this on the charts, but the movement was so extreme that you can see it like you could see it almost from space. I'll bring it up on the charts a little bit later after we finish this article. Quote, measured over a 4-day period, the increase in 30-year gilt yields was more than twice as large as the largest move since 2000, which occurred during the dash for cash in 2020. Quote, it was more than 3 times larger than any other historical move. Gilt market functioning was severely stretched, particularly at the long end of the curve. So why is this bad? Why did this create such a panic? I'm going to take a moment to kind of go over into those charts, just to show precisely what kind of move in the market that we're talking about. This is the monthly curve on the 10-year gilt yields, or rather, this is their value. And this isn't the specific gilts that they were talking about in this article. They were speaking of the 30 years. But if you look on the monthly, you notice that after 2020, when we started the recovery period, these bond prices, this is the value of the bonds at which they trade, had been in rapid decline. And over the past month, it got even more extreme. If you go to the daily, this is the panic that was being spoken of. So this entire drop, and keep in mind, this is values, not yields. We saw a 12% drop in the prices of these 10-year gilts in just 1 week. When they finally stepped in on the 28th of September, it gave it a huge surge in value, but it's only just barely propped it up. Now, the pension funds that they're talking about, these are bank managers, these are fund managers that are operating under a charter to protect the value of their pensioner investments. So you think of these like civil workers, policemen, firemen, blue-collar workers. They do good, hard work. And they're dependent on these fund managers to protect the value of their retirement investments. If these bond prices drop too quickly, then they have to unwind their positions. They're forced to by the statements of their charter. They don't really have a choice. And this is testing their this is testing the limits of their charter as it is. Now, the idea of them buying up all these bonds is that they provide a safe, fixed rate of return, and that's why it makes up a bulk of their portfolio. But when the prices of these bonds start dropping too quickly, the underlying value of those bonds lowers significantly, thus lowering the underlying value of their clients' pension fund. So, although they are dependent on those yields to provide a stable net income, they must simultaneously protect their clients from a surge of selling in the bond market. And if those bonds are starting to sell, then they also must therefore sell. Here's the problem, is that these pension funds are so huge, they serve more than 1.5 trillion British pounds value, which makes up for a huge chunk of this entire bond market. Like our stock market, our entire U.S. stock market is worth somewhere in the realm of 35 to 40 trillion U.S. dollars. And you think about that in terms of what the British pound is, that would be about 1.7 U.S. dollars in pension fund value. They make up almost, that would be almost 4%. It's more like 3.5%, but close to 3.5%, 4% of the total stock market value of the United States. That's how much money these pension funds hold combined in value in their bond market. That's a huge sum. So if they all decided that they needed to unwind their positions forcefully in order to protect their customers, that would literally create a fire sale situation. So this is why the Bank of England stepped in and rescued the pension fund. And they did this as an emergency measure, but they are far from out of the woods. In fact, they've probably made the situation even worse. Now the pension funds are going to try to figure out some other way in order to start moving to other assets. So this is still going to sell off. They maybe have stemmed the bleeding for a little while, but they basically just put a tourniquet on the market.
Race to the bottom.
Yeah.
It'll be a race to the bottom between the pension funds once it starts selling. Nobody wants to get bottom price, right?
Right. And the pension funds are now going to be competing with Wall Street and other foreign market hedge funds that are trying to make profit wherever they can. They are going to abuse this situation. It's in their nature. It's what they do. This competition that they're all in is going to lead to major selling in this market. And the really shitty part is that this is going to hurt the little guy the most, because that's who makes up this pension fund. And if you look at this, chart, you can see that very clearly. We formed a great big bear pennant on this chart, and we're already breaking down to new lows. And it's only been a week. We got a 3 crows pattern right here. 3 big red-bodied candles following a 3-line strike. This is the bearish version of that previous pattern that I had called out earlier, where we had the 3 red candles and then 1 big green engulfing candle. This is the opposite. 3 big green candles and then 1 engulfing red. That's a bearish 3-line strike. That means that the market is going to reverse to the downside, or in this case, it's going to continue the selling that this thing has been on for the last month.
What's the volume? Is the volume supporting the move?
Yeah, the volume is supporting the move because at the first movement in price action to the upside, the volume was declining. So as soon as you saw this increasing price action, the volume started dropping even lower.
Yeah.
And now that we've got this continuation, expect the volume to start turning around as the price.
That's right. Yeah, that's what I was going to say.
Goes down even further.
The volume support, that would be volume supporting it, high volume
Yep.
as it sells.
Yep. So this is
a doomsday scenario.
It pretty much is, and it's going to hurt pensioners. It's going to hurt everybody that's got all of their retirement savings in a place they can't take it out of. They're reliant on these pension funds to protect their investments and protect their retirements, and it's going to evaporate. We've got 2008 happening all over again, right in front of our very eyes.
Yeah.
And this is only the 10-year.
The hedge funds are in deep trouble because as the sell-off occurs in the market, their values are going to decline also. They're going to have to suddenly react in a fire sale manner. That's the doomsday scenario that's supposed to cause the squeezes. Is exactly this.
I can't pull up the 30-year gilts for the market. Owando only shows the 10-year. But this is the closest that we can see.
All the leverage and all the games that have been played are coming home to roost. That's what we're really looking at.
Yeah. Well, the pension funds are caught up in the middle. They make up so much money. These are not evil. Pension funds are not evil organizations.
No, not at all.
They're just trying to secure the incomes and retirements for the elderly once they're ready to move out of the workforce. Yeah,
they're victims of all the games that have been played by the banks.
Exactly.
And the hedge funds. It's the over leveraging now that's catching up.
Yeah, and this goes into what I was going to talk about today, which is that we are now facing a massive treasuries crisis. Debt is no longer good. We finally come to the end of the road where all of the debt that we have created and rehypothecated over and over and over again is finally crashing down around us. It's literally killing us.
Yeah.
So,
keep it going.
Right.
Can I just point out that bond buying program is scheduled to end on Friday, and these pension funds are busy trying to get collateral buffers so that I guess they don't have the same need to sell off again. It's at the very beginning of that next article. I'm not exactly clear how it works, but it sounds like it's not good.
I will pull that up and we will read through that next because I've got another article to follow up with as soon as we complete this one. So
Thank you.
Yeah, we'll go ahead and read through this one because it all ties together. This is all related. And this is part of the rehypothecation machine that I was talking about. Well, guess what? The rehypothecation machine broke, and now they don't have any other options. So, pension funds brace for the end of Bank of England's intervention. Funds boost collateral buffers as much as 300 basis points as October 14th deadline looms. Pension funds are beefing up the collateral buffers required to maintain their interest rate hedges as the Bank of England's emergency intervention in gilt markets draws to a close. Prior to last week's events, most funds maintained collateral buffers to withstand a move of 100 to 150 basis points in gilt yields each year. With the Bank of England's gilt purchasing due at the end of October 14th, funds are readying for scenarios as extreme as a 400 basis point jump higher. We're seeing people preparing to withstand a 200 to 300. So the article won't let me read the rest of it.
Oh, sorry.
That's okay. Okay, I got this article from Yahoo Finance. Cash crunch for British funds puts regulators under pensions lens. So this kind of touches on the topics that we were talking about with the deadline. Sadly, the site was paywalled and I couldn't get past it. But here's some of the highlights. The scramble is revealing a complicated web of regulations, and the regulators are currently focused on the October 14th gilt market deadline, while pension funds are building up collateral pools. Regulators says that no plan could foresee the jilts move. I beg to differ. Honestly, the bonds collapse was quite predictable. We've seen the same thing happening in the US markets. They have equivalent research. This should have been we're going through global inflation, right? The market is completely turned upside down on everyone at the same time. And you have Credit Suisse that's now toying with the idea of bankruptcy as they desperately try to cling on to life with only the riskiest of bets keeping them alive. And it's only a matter of time before something blows up in their face.
Yeah, the credit swaps, right, that they're selling to the riskiest investors, or that they're covering the riskiest clients.
Yeah. There's so much counterparty risk in the market that as soon as one organization fails, it's going to create this cascade, this domino effect of all these other funds blowing up. So let's go read through this article and see what it has to say. So a scramble for cash made by British pension funds after last week's bond market crash raised questions about the oversight of a £1.6 trillion business that's grown rapidly in recent years. Pension funds had to post emergency collateral in liability-driven investments, or LDIs, which deploy a mix of both leveraged and unleveraged derivatives to safeguard against shortfalls in pension pots after British government bond yields rocketed, correlating with a huge plummeting of the price. To halt free-falling prices, the Bank of England was forced to pledge as much as £65 billion of long-dated government bonds known as gilts. Many pension funds struggled to find the extra cash at short notice. Some had to sell gilts in a fire sale that put further upward pressure on the yields and threatened a wider meltdown. Quote, pension regulation is not the direct remit of Bank of England, but stability of the financial system is, said Ian Tonks, professor of finance at the University of Bristol Business School. After the global financial crisis more than a decade ago, regulators tightened rules on banks, but pension funds, issuers, and asset managers remain more loosely regulated, prompting warnings of even greater threats to financial stability. LDI is a regulatory gray area, one pensions industry source said. The pensions regulator, TPR, has day-to-day oversight of pension schemes to ensure that they're well hedged, but it is not a financial regulator, meaning it's less focused on the risk behind the scheme's use of financial instruments. Pension trustees decide on whether to use LDI, often based on advice from consultants, which are not required to be regulated. The TPR guided in 2019 that it was common practice to use LDI to improve the matching of assets and liabilities. LDI funds used by British pension schemes were largely listed in Luxembourg and Dublin, but their managers are based in Britain and regulated by the Financial Conduct Authority, while the Bank of England regulates banks, some of which act as counterparties. The rising leverage. LDI was born out of a need to plug shortfalls in defined benefit pension schemes, especially as central banks slashed interest rates after the global financial crisis. Its popularity has boomed in recent years, helping many pension funds not only meet these long-dated obligations, but also generate a surplus. But leverage in many LDI products was still rising in 2022 as central banks started hiking rates. That turned positions once largely designed to be defensive and protect from falling interest rates into riskier ones, much more exposed to movements in rates and inflation as bond prices fell and yields rose. Insight Investment, one of the largest LDI providers, said in a May 5th note that clients should top up collateral pools sooner to reduce risks of being a, quote, forced seller of assets at potentially inopportune times. It estimated that a scheme with 3 times leverage at the start of 2022 would have seen it rise to 4.5 times as bond prices fell. Given recent market events, we're working with some UK pension fund clients to reduce their leverage in their LDI strategies. This aims to ensure that their liability hedges remain resilient. TPR and FCA have been talking with LDI funds since the spring on their ability to cope with higher collateral demands as central banks began raising interest rates. People familiar with the situation and a source close to the regulators said. But last week, yields on gilts rose 160 basis points in just days, above a maximum 100 basis point swing in a 2018 assessment of the sector's capacity to cover margin calls on interest rate derivatives, said the Bank of England. So I'm just going to highlight some of this. So most of these schemes have been estimated to be operating with 3 times leverage at the start of 2022. And leverage is directly tied to collateral assets, i.e. bonds, or gilts in this case. And as the bond prices fall, the leverage increases because the assets becomes less valuable that they are using as a hedge against all the other assets in their portfolio. And they were told as early as May that their clients should top up on collateral pools. That's alternatives to these bonds which provide the leverage. So they were warned more than 4 months ago that they needed to start deleveraging themselves and chose instead not to, or were too slow to act. And now that the bonds yields are skyrocketing and their prices are falling, some of these pension funds are now in a position where they may be a forced seller, somebody who is by law and by their charter of their agreement required to sell their assets in order to protect what remains of their client's investment. But now it's happening all across the industry and resulting in a mass capitulation of the bond market over in the UK. This is going to have wide-sweeping consequences well beyond the pension funds. The fact that the pension funds, which are supposed to be some of the safest and some of the most conservative of strategies to ensure a fixed yield income for retirees, is failing, and they are becoming forced sellers in what is known as the safest fixed income asset market, is extremely terrifying, because these bonds act as a form of debt for the government. This is the same way as the way our bonds work in the United States. Our 10-year bonds, our 20, our 30-year bonds are no different than these 10-year, 20, and 30-year gilts for the UK. And the fact that now this entire market is starting to collapse under its own weight due to pension funds absorbing leverage through this market and attaching it to other riskier strategies is beyond terrifying. When this starts to fall apart and the pension funds start to lose their asses, this is going to result in a massive drop in the value of UK financial debt. All these bonds are going to become, I won't say worthless, but they will drop in value so far that it will throw out of whack all of the other collateral that's attached to these gilts. So, industry officials say that some LDI funds required collateral for up to a 150 basis point move, but last week's moves blew past that too. Quote, "The scale and speed of the recent repricing far exceeds historical moves," said the Bank of England. The FCA and TPR declined to comment on whether there was more that they could have done. Luxembourg regulators had no immediate comment. The Central Bank of Ireland said that it was aware of developments in the UK gilt markets and has been monitoring the potential impact on Irish and international markets. Pension schemes are building pools of cash in case they receive fresh margin calls from LDI managers when the Bank of England intervention ends on October 14th. The bank has been working with the FCA and TPR in recent years on enhancing monitoring of the risks in LDI funds, Deputy Governor John Cunliffe said on Thursday, adding that lessons need to be learned and the appropriate level of resilience ensured. LDI funds are not required to hold capital buffers, but must show the FCA they have systems in place to manage risk. David Blake, a financial professor at the University of London, said TPR may have to set leverage limits, but imposing more restrictions will have to be weighed up against how often such events are likely to happen and radically changing a mechanism that has largely served the sector well. Meanwhile, pension funds are likely to become more cautious and LDI providers are cutting the allowed leverage. Quote, "There is a significant aversion to illiquidity because obviously of the problems that we have just witnessed in raising money for collateral calls in these conditions of extreme market moves." And this was said by David Lloyd, head of institutional fund management at M&G. So the key word here is illiquidity. The reason why these moves become so extreme is because of illiquidity. The fact that these bonds have been moving in prices so quickly is because of their need to act as collateral for other assets. And why does any financial institution need to have collateral assets? Especially if it's a cash equivalent asset. They need it for leverage. They need it so that they are able to enter into strategies that allow them to make additional cash off of these rehypothecated treasuries or gilts. The terms at this point are interchangeable. But when we say illiquidity, we're talking about a lack of monetary transition. There's lack of transactions. There's very few trades happening in this market. And when you have low volume in a market like this, it allows the price to move very quickly. Notice that this move is dwarfed by the collapse during COVID. So what I want you to pay attention to is the volume here. 500,000 in volume over the last 39 days. Let's go from March of 2020. Let's see, this is, we'll go from March 9th of 2020 to the 18th of March of 2020. That's the same amount of volume in just 2 weeks. So the same amount of volume in just a 2-week period during one of the most ridiculous and extreme black swan events of our market. And this volume was the same amount over the course of a almost 2-month period. And although you see this pop in volume here, this is because the Bank of England injected so much cash into this market, buying at any price so that the pension funds could get out, which is inflation, by the way. They're printing money to do this so that these pension funds can get the hell out and escape without losing absolutely everything and leaving all of their clients destitute in retirement. That's the only reason why this volume is here. And this move, this entire move, totally dwarfs the move that happened in COVID. The move in the COVID crash, from peak to trough, all the way to the bottom, this was an 8.5% move. And this was the worst black swan event that we have seen in a single month of trading since the crash on Wall Street in 1987, Black Monday. We haven't seen anything like that since that time. And now we're having this massive crash in the bond market that totally dwarfs this move with such little volume. That is the entire reason. There's nobody trading these. Nobody wants to sell because they're holding on to these assets, or more likely, they have rehypothecated, meaning lent out these assets so many times, created so much leverage that it's impossible for them to recover their assets in a timely manner such that they can sell them at market and provide additional liquidity to the market when needed. They have to track down who's even holding the damn things. At this point, the market is so out of whack and so panicked because bond prices are collapsing and the yields are skyrocketing while no additional treasuries are going out on auction. It's providing no liquidity to the market. There's nowhere for them to actually get these assets. And there's no one for them to trade them to. Because right now, everybody sees the yields going up. Nobody wants the old ones. It doesn't make sense. So now these fixed income assets have basically become an anchor that they're having to drag behind them and try and find somebody who wants to go and buy an old rusty anchor. So this is creating all kinds of additional problems elsewhere. The global market is going to get even worse. Let me catch up with the article that I was originally going to show all you guys. So Treasury's liquidity problem exposes the Fed to its biggest nightmare. JP Morgan measure of security market depth continues to plunge, and Bloomberg's gauge of how far yields are from fair value is rising. The latest bouts of global financial volatility has heightened concerns about regulators' continuing failure to resolve liquidity problems with U.S. Treasuries, the debt that serves as a benchmark for the world. It's getting harder and harder to buy and sell treasuries in large quantities without those trades moving the market. Market depth, as the measure is known, last Thursday hit the worst level since the throes of the COVID-19 crisis in the spring of 2020, when the Federal Reserve was forced into massive intervention. With rising risks of a global recession, escalating geopolitical tensions, and the potential for further defaults by developing nations, not to mention ructions in a developed economy such as the UK, Investors may not be able to rely on treasuries as the reliable haven they once were. We have seen an appreciable and troubling deterioration in the treasury market's liquidity, said Krishna Gua, head of central bank strategy at Evercore ISI. Regulators, quote, really haven't delivered yet any substantial reforms, unquote. What we're seeing at the moment is a reminder that the work is really important. This chart is showing the Bloomberg U.S. government securities liquidity index, which is showing a massive margin of error in the market's yields versus their value. So this is basically a spread curve. This is showing the difference in spread between the yields and the price as they become more and more detached. So the higher this goes, the more extreme the pricing becomes, and it becomes more and more difficult to trade the market at an agreeable price. So you're being forced, if you must take the trade, if you are in a forced selling posture, then you are taking the worst possible price. And I'm assuming that this is a index that's measuring the yield error as a percentage of difference. So 2% doesn't sound like a whole lot, but this could be the difference of a few $100,000 versus millions of dollars when it comes to the quantity of treasuries that these big guys are trading. And like they said, that this is the worst that it's been since the liquidity crisis that we actually had in 2018. There was a huge liquidity crunch that took place in 2018 when the overnight repurchase agreement market was closed. The repo market was closed by the Fed. And simultaneously, they had been trying to go through a tightening cycle of their own, trying to work down the balance sheet of the Fed that had been grown so much during the recovery phase coming out of the great financial crisis. And this spike that you see here is a result of them shutting that market down. So this entire situation is we can squarely blame on Fed policy for one, as well as panic in the market. And this is basically a big signal that the yields in the bond market are about to take the hell off. The tighter this is, the tighter this spread is, the smaller this number is, the better that markets are functioning, and the easier that it is to get in and out of positions at agreeable prices. The higher this goes, the more extreme measures you must take in order to take a trade. And at this point, nobody wants to trade. When things are this extreme, nobody wants to trade. So when the Treasuries market broke down amid a panicked rush into dollar cash in March 2020, the Fed swooped in as buyer of last resort. And while it's now has a backstop facility allowing the exchange of treasuries for cash, volatility, if extreme enough, could still force the Fed into action, observers said. That's particularly awkward now when policymakers are not only raising interest rates but actively shrinking the portfolio of treasuries. So-called quantitative tightening is supposed to be playing a, quote, important role in tightening monetary policy as part of the central bank's battle to contain inflation. Quote, the biggest nightmare for the Fed now is that they have to step in and buy debt, said Priya Misra, global head of rate strategies at TD Securities. If the Fed has to step in when it's in conflict to monetary policy, it really puts them in a bind. That's why I think regulators need to fix the market structure. The Treasury Department is working on an initiative to enhance transparency in the trading of U.S. government debt, seen as one step that could encourage dealers and investors to boost volumes. News on that front may come at November 16th annual market structure conference. Lifeblood importance. But the outlook for bigger reforms, such as the Fed's relaxing banks' capital requirements connecting to how much treasuries they hold, remains unclear. An independent panel this past summer criticized regulators for the slow pace of their efforts. Quote, I do think that the official sector is moving, but there's a lot more to do, said Darrell Duffy, a Stanford University finance professor who served on that panel. Duffy, who's currently seconded to the Federal Reserve Bank of New York, added that, quote, the Treasury market is the most important securities market in the world, and it's the lifeblood of our national economic security. You can't just say, We hope it will get better. You have to move to make it better. World's most important market still needs some work. So for now, things are not better. With what would once be viewed as outsized daily yield swings becoming commonplace, a Bloomberg index of liquidity levels, which measures on average how far yields are away from where fair value models say they would be, shows that conditions have deteriorated. Just on Thursday, Treasuries extended losses in the wake of a large sale of futures contracts. Prices had been falling, sending yields higher in the wake of hawkish comments from Minneapolis Fed President Neil Kashkari. And here's the Fed's take. Quote, market liquidity is definitely lower, New York Fed President John Williams acknowledged this week, but he added, quote, it's still functioning. I don't know if you guys can feel it, but I'm rolling my eyes all the way across the room right now.
I mean, oh God.
Fundamental to the structural challenge.
That's the last thing you want to say. You don't say that.
No, it's not.
That means that people are worried about, well, they're thinking about it might not be functioning. Oh man.
It doesn't really set the mood for a positive spin, to be honest with you.
No, it'll panic people.
So fundamental to the structural challenge is the surge in supply. Treasury debt outstanding has climbed by $7 trillion since the end of 2019, and big financial institutions haven't been as willing to serve as market makers, burdened by the so-called supplementary leverage ratio, or the SLR, which requires that capital be put against such activity, as well as reserve holdings. So this is basically the margin requirement for banks, the big institutions that would be buying these securities. The Fed raised it, and now they're throwing a hissy fit saying, no, you need to take this away now, because they got used to it not being there and gave them a lot more money to trade with to create more leverage. But it was only taken away in order to serve as a bit of leeway for the banks during a crisis situation. It was never meant to be permanent. Now the banks want it to stay, and now they're calling it a burden, even though it is literally there to act as a hedge against market risk. So they want the risk gone. This is so stupid. Fed Governor Michelle Bowman encouraged some observers with remarks this week signaling openness to adjusting the SLR, but Bowman's not in the key role overseeing such moves. Thank God. Don't take it away.
I agree. Yeah.
This will fall to Michael Barr, the newly installed vice chair for supervision. Josh Younger, J.P. Morgan Chase & Co.'s global head of asset liability management, research, and strategy, agrees with Williams that for now the system is, quote, functioning. But for treasuries to serve the purpose for which they've been anointed, which is a cash substitute, the intermediation mechanism needs to be more robust, says Younger. It's still important to fix the system so that it can handle a March 2020 type of strain. Among the other moves regulators are looking at is enhancing the role of central clearing of treasuries, for which the Securities and Exchange Commission has put forth a proposal. For its part, Pacific Investment Management Company, centralized clearing is instead of a market maker and clearinghouse to be in charge of the clearing of trades in the securities and treasuries market, you would have the central banks acting as the clearing firm. And that somehow feels a lot more dangerous, considering the Fed can't even get their already existing job right. I find it extremely discouraging, the idea of putting the central banks in charge of it, of what's already a huge financial burden. This will just create more opportunities for inflation to take place as they just print money in order to fulfill clearing obligations whenever somebody gets margin called and says, but we can't. So let them fail. That's the way this market is supposed to work. When somebody screws up that badly, when somebody f***s up and throws all of their clients' money into the throes of a tumultuous market, over-leverages themselves on all this stupid risk, and then they lose it and cry about it, you lose it. That's what you get playing in the f***ing casino like a dumbass. You don't manage your risk. When these big financial institutions do this kind of thing, this is what they deserve. You let them fail. You don't put a big institution that's able to print unlimited amounts of money, just save them and throw a fucking net underneath them when they're the ones that jumped off the goddamn cliff in the first place. They are getting what they deserve. These institutions were wholly irresponsible. We should have let them fail in 2008. God.
Yep, and I just want to point out that I posted an article about banks dialing up the risk in the OTC derivative trades and using many of the same non-bank counterparties, which sounds a lot like 2008. And another one where the Treasury Department is supposed to start some type of ownership registry. I don't know how it's going to work. I just posted the article. I haven't had a chance to read it yet.
Oh my
And
God.
one last point is the fact that a lot of these banks, basically because the OTCs aren't regulated, are expanding the money supply on their own, and you don't even know where it's going and what they're doing with it. And when that comes to, that's on top of the Fed expanding the money printer. It's scary.
Oh my God. When the banks start getting involved in the OTCs market, it's because that they know that they can move it so easily. They're going to try to resort to stealing from people now. So the OTC market is about to get extremely volatile and f***ing scary.
Yeah, especially when they go there because they're doing things that allow them to avoid certain laws because everything's private. There's no reserve requirements or anything else. They just make deals and don't have anything to back it up.
Oh my God.
What a wonderful world.
Oh, man. The individual initiatives being discussed may not be silver bullets on their own. No shit. But collectively, they would contribute to a more efficient, resilient, and liquid market, said Stephen Berger, Global Head of Government and Regulatory Policy at Citadel Securities. Delaying unnecessarily the implementation of the market enhancement being discussed perpetuates the risk that the Fed feels compelled to intervene during a future market dislocation. Oh my God. So the only people that this helps is the big institutions that have over-leveraged themselves into a corner. I'm going to have to try not to turn this into a rant, otherwise this will go on forever. But
you can do a separate video on it.
The current financial conditions of this market have basically spelled doom in great big red letters across the wall of the Federal Reserve. And rather than allowing the large institutions to fail and do what's necessary, they're trying quite literally to save the world.
They're trying to backstop it again. They can't. They don't have the, like I said, the wherewithal. That's the bottom line.
They don't have anything.
They're in a different position now. They can't do what they're trying to do. It's not going to work. So we're in deep trouble.
They never should have been doing this in the first place. They never should have been trying to save everybody. It was it's not. You can't. You can't.
Agreed.
There is no way that you can allow banks to over-leverage themselves to the point where they are breaking as soon as one of their bets goes against them.
Yes.
Statistically, it's going to happen. And the fact that any of these banks have gotten so used to it just speaks to how disjointed their mindset is from reality. And the fact that the Fed and the SEC are combining their efforts to save them after they have created this disaster is corruption of the highest order. And as these guys continue to get bailed out by these monetary policy decisions, implementing new systems in order to save them from their own stupidity and basically wipe away the debt or give them additional leverage to just make it worse later is stupid. It's beyond lunacy.
I don't think they can do it anyway, though. I don't think they can save everybody this time.
They're going to try.
Yeah, but it's not good. They don't have the resources. They're 31 trillion. We're 31 trillion in debt now.
But the thing is that every single decision they make to try makes the situation worse. Because these guys don't learn. The banks don't fucking learn. They will never, ever come to terms with their failure. If we do not allow them to fail and then save the customers that they have f***ed over instead of the banks themselves, they need to take the bank's books, they need to take the assets, seize all of them, and they need to liquidate their clients' assets. Give them their cash, move them to a new firm, give them somewhere to go, give them their money back, and let the bank go under. Let the f***ing executives hang for it. They made these decisions. Their bank managers, their hedge fund managers are the ones that put them here. And they have totally dicked over their clients. They have been gambling with free money. And then they made the Fed print more. And now they want them to clear the money for them. Now they want them to clear the trades for them. Now they don't want margin calls. F that. These banks need to die. They need to fail. That's what has to happen. They have to go
I
under.
agree. And new regulations need to occur because
The Fed needs to put.
never have a
The Fed needs to pull its head out of its fucking ass and actually go save the people that have their money tied up in these banks, not the banks. Don't give money to the banks. They'll just bet with it. They'll just spin the roulette wheel and bet it all on 0-0 again, just like they did the other 20 fucking times. This needs to stop.
Credit Suisse, right? I.e. Credit Suisse. We're about to see the collapse begin.
You got that right. I don't really have time to go into that, but Credit Suisse is dead. Credit Suisse is going to die.
Do you think who here thinks there's any chance Credit Suisse survives? Just curious of all the people. I don't know if these people raise hands. I'm curious if anybody thinks they're going to survive this in the long run.
No, I think that their government, because they actually have some intelligence over there in Switzerland running their central banks, they're actually going to let Credit Suisse fall apart. Because they understand that they have basically given all Swiss banking institutions a bad name. I think they have decided that Credit Suisse needs to fail in order to say, like, they need to
It would be
send
the
a
right
message.
move.
It is the
Even
right
as
move.
painful as it is, it would be the right move.
Financially, it sucks. But
It
politically,
would also draw
morally, and
attention here.
ethically, it is the perfect move. It is the exact thing that the entire Swiss government needs to decide collectively to do, is to seize all of the bank's assets of Credit Suisse. They need to go after all the criminals that they've been servicing, go and take their fucking money, go and put them in handcuffs. Well, they're overseas. Like, they're all global organizational criminals, so it's not like they're going to be able to just go and send somebody out to go and arrest them. But
Yes,
Interpol, I guess Interpol could get involved, sure, but like, how many times do we see Interpol actually make a meaningful
I mean,
arrest?
it depends. Yeah, there's a lot of political intricacies. It's not the logistics; it's the political intricacies that may get in the way. Yeah.
Yeah, but the point is that the entire situation with Credit Suisse, and I'm not gonna go into this entire article. If everybody else wants to read that, it was eFinancial Careers news article on the Credit Suisse clawback. But the bank is failing. They're protesting every bit of cash that is being seized from them at the moment. And now credit default swaps against Credit Suisse's assets are through the roof. Like, the market for credit default swaps betting against Credit Suisse, it's an insane chart. Just go Google it. It's amazing. It's like
500%.
Yeah, it's literally like looking at a squeeze chart. It's literally like the credit default swap market against Credit Suisse has squeezed with how much value is betting that Credit Suisse is going to go bust.
Yeah.
It's like a guaranteed bet for these guys. They're like, yep, you're dead.
The stock has probably been manipulated to death also now.
Oh, I'm sure. Credit Suisse is doomed.
To make
Credit
sure that
Suisse
they get
is
killed.
so doomed. They're so doomed.
Yeah.
It's honestly incredible. It should have happened many years ago, but seeing Credit Suisse's chart just collapsing into the void. Oh man, it feels.
How long do you guys give it? That's the question.
I give it a year. I give it one more year.
A whole year? Wow.
Yeah, I'll give it 1
I
year.
was thinking before then.
They've got so many assets that they have to unwind, but the collapse. I mean, Bear Stearns, their collapse from the point that it became obvious. It took a year. Like, we knew that Bear Stearns was going under in March, and it took until it was like 8 months, and then they went into bankruptcy, and then it took like 4 months for J.P. Morgan to acquire them. So about a year. But like, now it's obvious to us that Credit Suisse is collapsing, so I give it about a year. Yeah.
Yeah. But there's like a dead man walking, right? I mean, that's what you're looking at. You just look like almost like the unwinding of it, like pre-bankruptcy move.
Yeah.
Is essentially what's happening. Anyway, I want to go.
And what tipped that was extreme amounts by all these big banks of overnight repo loans in crazy amounts never before seen. That's what kind of alerted them when they stopped getting those loans overnight. That's what caused that collapse.
Mm-hmm.
What was that? Scrap? You said that
They were large repo loans.
Oh, the repos, the Credit Suisse is not.
Or maybe they're bank loans, and that they were due out the very next day. And the first time that they weren't able to get one of those loans based on rumors of collapse because no one knew where the toxic stuff was, that's what precipitated the collapse. So what Persephone's been looking into, I think, is where you're going to see one of those first signs.
That would be a bad sign, a really bad sign if they can't participate in that market.
I think that we're starting to see the entire circus unravel now. The whole game is starting to fall apart. As I said in the movie Margin Call, the music has stopped.
I think so. It looks like we're in the end game there. Anytime you see the treasury market in trouble, that's the lender of last resort to the world, right? So
yeah,
it tells you everything you need to know, essentially.
I was not ready to see that U.S. budget surplus chart. The deficit is insane.
Oh yeah, it's the 31 trillion.
Oh,
it's a number so big you can't even think about it. It's incomprehensible. So it is. You can't really it's like a wonder how we're even still functioning, so to speak. If you read that article, we're still functioning.
The market, yes, the liquidity is very low, but it's still functioning. It's
that's the quote of the week.
That's like looking at a car that it's got its whole hood missing, smoke coming out of the engine, and it's just rolling on neutral down a hill. And you're like, yes, its speed is very low, but it's still going.
It's still moving, yeah.
Like the car's engine block is on fire, but it's still going down the hill, like down the hill towards the brink of a cliff.
Yeah. If you need to say that's if you need to come out and say that, you're basically saying the exact opposite of what you're trying to say.
Yeah, that's stupid gravity.
Oh my god.
Yeah. Like the idea is that it should be taken for granted. It should be taken for granted that it's functioning. So when you say something like that, the only reason you would say things like that is if it wasn't functioning before, and you want to let people know, hey, we're back. But when it's supposed to be functioning, it seems to be functioning, and there's no problems. It's like don't was it? If it ain't broke, don't fix it, right? It's kind of like that, but except the opposite. It's like they're trying to break. They're trying to break it further by saying that. That's what the result is not trying, but that's the result. It's like you're letting people know, hey, what used to work normally ain't working normally no more. Did you know that? That's kind of like what's announcing.
Yeah, pretty much. Oh man, I'll end it here. Looking at the just to take one last look at the SPY's chart. After reading all of this, I know that probably nobody right now is feeling very good, but just after watching all of the central banks and literally everybody, literally every single central bank completely blunder the outcome of this financial meltdown, that it didn't have to happen this way. It really didn't. But watching them screw up so badly has
that's what happens when you have unregulated capitalism. That's what we have in the financial markets, raw capitalism, and you see what happens.
Yeah,
I hate to say it, but that's what you see because there's dominated by a few large organizations who have influence, and basically that allows you to have errant behavior, right? That's what you do. You do things you normally wouldn't do if you were being regulated, if you're being watched, or you didn't have influence over the market. You wouldn't be doing some of the moves you're doing.
No, they wouldn't be. But nevertheless, here we are. So I've got one last look at the SPY's monthly chart, and I'm just measuring some of the crashes that we have been through. This is a logarithmic chart, by the way, so this shows a bit better to scale based on the long-term performance of the SPY. But given where we are currently trading in the market, we still have a long way to go before we see the bottom. Our market needs to see a 50% give back of the entire market's value. And honestly, I think that we are... I'm now convinced that this is probably going to lead to a global depression. I'm no longer thinking of a recession anymore. That's a foregone conclusion now. We are in a recession, and it is coming, if it's not already here. But now as the financial chaos begins to unwind around us, as we see Russia continuing to double down on their already losing bet to annex the Ukraine, China and India siding with them, which is going to place the entire Asian market into basically into
China. I don't think
collapse.
China. I think they're moving more towards a neutral position. TD. I mean, they're not overtly criticizing Russia, but behind the scenes, they're pushing them. I can guarantee you, this is bad for China. They do not want this a long war. They are pushing away, and India also, for their own reasons, does not want this. Is against this war now.
Say that again. Tell me that again once. Tell me that again once China's made its decision on whether or not it's going to give up Taiwan forever.
Well, they're looking at 2027. They've been given orders to get their army ready to attack, even with the U.S. forces present by 2027. I read that the other day. I was quite surprised. So
we'll have to save that one for another time.
Yeah, but this is different than because Europe is China's customer and they don't want a recession and Russia's causing it. That's why China has a financial interest that diverges, which is why they want Russia out. That's why I'm saying that.
But simultaneously are dependent on Russian oil because it's the only country where they can cheaply receive it from.
Yeah, I mean, are you talking about China or are you talking about us? Or
China.
You mean the global supply?
Global supply as well, but
they're not against Russia. Like I said, they're not against Russia. They're against the war, right? They want the war. They want to push, discourage Russia from continuing the war. It won't work, but
no, probably not. But
yeah,
oh well.
So it's a complicated situation there.
Got that right. So, SPY, I'm looking at least a 55% drop in the SPY over the long run now. We're now looking at like major crash on a scale that probably it's probably going to look a lot like 2008 in the best case scenario, in my opinion. We're now at a point where I'm worried that this market could get so severe that we may be looking at a 1929 style market crash where the market gives back 80%. It would mean basically the end of capitalism as we know it if something like that were to happen.
Yeah, I think so. I don't think we could, like I said, we could recover from that again. Where at this point,
I'm really praying that nothing like that is seen here because like this chart is not a joke. The crash of 1929 through 1932 saw the entire stock market give up 90% of its value.
We would have a revolution here. In other words, we wouldn't be able to sustain a stable transition in government. We would clearly have a revolution if that happened again.
Well, you're absolutely right about that because, as with before in 1929, the government actually had money and it had the ability to create wealth.
Yeah.
We don't have that anymore. We have a debt society, and we actually created the Federal Reserve and added to its market necessity and function as a result of the Great Depression. The Fed got most of its power as a result of the Great Depression. It is because of the Great Depression that we needed them. And now we see that we are in the exact same situation, only about 10 times worse. And now the Fed is the cause.
Yeah. It's now worsened rather than gotten better with using the federal. They're not the lever. They can't be the lender of last resort. That's what it comes down to. Their power is very severely diminished, if not gone.
Yeah.
Because of the debt, like the overwhelming debt.
That's what we're looking at. So I'm going to leave this here. As I mentioned earlier on in the call today, we are looking at a short-term bounce for the market on Monday. Be ready to make an entry into some short positions on the first sign of weakness. And good luck, everybody.